Hello everyone, this is Dr. Mihir Shah once again with another video. In this video we are going to take a final revision of all the practical problem sums, namely 6 types under the subject Investment Analysis and Portfolio Management, also known as IAPM. Again, a very important video for all the TYBMS Sem V students. So in this video we are going to take up all the various types of practical problem sums under the entire syllabus. So let us start one by one. The very first type 1, is based on the chapter called Risk Return Analysis. Under that, the topic that we're going to learn will be calculation of expected return and standard deviation. So let us see the very first sum. Okay, how to calculate expected return and standard deviation. Okay, the very first type of sum is based on risk and return analysis, and under that we are going to solve sum based on calculation of expected return and standard deviation. Now, for finding expected return and standard deviation, there are two types of sum. Number one, when probability is not given, and one where it is given. So we are going to solve first sum based on when probability is not given. The formula for expected return is R bar is equal to sigma R upon N, and standard deviation का formula is the root of sigma R minus R bar the whole square upon N. Now based on the two formula, let us see how to solve the sum. Okay, so the question given here is Mr. J gives detail of his portfolio. There are multiple years and they are giving you returns of A limited and B limited, and they are asking you to calculate the expected return and standard deviation. So let us start finding the expected return and standard deviation for A limited. Okay, now the columns will be years. So under years we will note down 2003, 2004, 2004, 2005, 2005, 2006, 2006, 2007, and last will be 2007 to 2008. Now under returns, let us just note down whatever returns have been given to us. So it's 6%, 48%, negative 15%, 7% and 11%. The total of that will be required. So when you add up and when you subtract the negative 15, you get the total as 57. So now very first thing what we need to find is expected return. Expected return is nothing but R bar, which is sigma R upon N, where R ka value is, the total of R was 57. Number of, so 1, 2, 3, 4, 5, so we have 5. When you divide, we get a value as 11.40%. So our expected return is 11.40%. Okay. So we finish with the expected. Now in order to find standard deviation, our next column is R, that resembles all your returns, minus R bar, that is the expected return. So it will be 6 minus 11.4, 48 minus 11.4, negative 15 minus 11.4, 7 minus 11.4, and 11 minus 11.4. So the difference, so we'll get the difference. So 6 minus 11.4 is negative 5.4, following it with 36.6. Negative 50, negative 11 will give you negative 26.4. 7 minus 11 is negative 4.4, and 11 minus 11.4 is negative 0.4. Now the last column, you need to find the square of the value that you have found in R minus R bar. So the square of these numbers will be 29.16, 1339.56, 696.96, 19.36 and 0.16, the total of which will be approximately 2085.20. So we have got the value. Now let us see how to get their standard deviation. So standard deviation ka formula was, it is the root of sigma R minus R bar the whole square upon N, which would come to, the root of 2085.20 upon 5. So you divide, and then when you press the square root sign, we'll get a final answer as 20.42. So we finished with the first part of A. So we got the expected return of 11.4% and the standard deviation of 20.42. So this was of part A. Now similarly we'll have to do for B limited. So years mein again we have 2003, 2004, 2004, 2005, 2005, 2006, 2006, 2007 and 2007, 2008. Under returns we'll note down as 12, 40, -6, 23, and the total of which will come approx to. So we add up the values. So we have 12 plus 40 plus 20 plus 3 minus 6, which comes to 69. So we need to find the R bar, that is expected return, that is nothing but the total of R divided by N. So in our case it will be 69 divided by 5, which comes to 13.8. Okay, this is how we found the value of expected return. Now let us find the value of standard deviation. So we need to find now R minus R bar for the standard deviation. So R, we have all the values of return and we have to subtract that with your R bar. So 12 minus 13.8 will give you -1.8. Next it will be 26.2. Next -19.8. Next 6.2 and 10.8. Next we need to square them in order to get R minus R bar the whole square. So it will be 3.24, 686.44, 392.04, 38.44 and 116.64. Once you get that, we total it up. So after you get that, we total it up and we'll get the value as 1236.80. Lastly, we need to find the value of standard deviation. So standard deviation is nothing but the square root of total of R minus R bar the whole square upon N. So it will be nothing but the square root of 1236.80 upon 5. The value of which, after dividing and pressing the square root, you should get the answer as 15.73%. Yeah. So with this, we were able to solve sum based on expected return and standard deviation when probability was not given. This was the very first type. Now we'll be solving sum in which we will be having the probability. So let us see how to solve sum based on expected return and standard deviation when the probability is given. Okay, now the second method for finding the expected return and standard deviation is that when probability is given. Two formulas: expected return is equal to R cube is equal to sigma P into R, and standard deviation is the root of summation P into R minus R bar the whole square. Now the question given here is the rate of return of A limited and B limited are given below. There is probability which is given, 3 conditions are given and 2 companies are given. We need to find the expected return and the standard deviation. So let us see now how to solve this particular sum. First we are going to solve for A limited. So we'll note down this as A limited. Particulars mein we have been given 3 conditions. One is the boom period, the other one is normal period, and last one is the recession period. Now the probability which is given here is 0.3, 0.4 and 0.3. The returns of A limited are 40, 60 and 80. Now we need to find P into R. So we'll multiply probability into return and we get the values as 12, 24 and 24, and we need to get the total of P into R, which comes to 60. So here our first formula, that is expected return R bar is equal to summation of P into R, which comes to 60%. So that's our first answer. Now let us see how to find the value of standard deviation. So next column is R minus R bar. Now R minus R bar will be all the values of R, subtract with R bar. So the difference we will get it as negative 20, 0 and positive 20. The square of that will go into our next column. So negative 20 the whole square is 400, 0 400, and lastly whatever value we have got in R minus R bar the whole square, we multiply that with the probability. So we get the value as 120, 0 and 120, and we need the total of the last column, which is 240. So now finally we need to apply into the formula of standard deviation, which is nothing but the summation of P into R minus R bar the whole square. So which comes up to, that will be the root of 240, which comes to 15.49%. This is how we had to solve for A limited. Now similarly we'll go for the next one, that is B limited. Now again particulars may we have three conditions. So we have the boom condition, we have the normal condition, and we have the recession. Now the probability given here are again 0.3, 0.4 and 0.3. The returns are 90, 60 and 40. So we will add up that. So we get the answer as, okay, returns actually we don't need to add up. We will multiply first and then we will add up. So 0.3 into 90 will be 27, 24 and 12. And now we will add up this total. So P into R ka total comes to 63. So our value, the expected return is sigma P into R, which comes to 63%. Next is R minus R bar. So all the values of R minus is 63. We get the values as 27, negative 3, and we will get this as negative 23. The square of that, so we have 729, 9 and 529. Whatever value we have got in R minus R bar the whole square, we multiply that with the probability. So we get the values as 218.7, 3.6 and 158.7, and we will total it. So the total will come approximately 381. Once I get the total, lastly we will put that into standard deviation ka formula, that is summation of P into R minus R bar the whole square. So that is the square root of 381, which comes approximately up to 19.52%. So with that we were able to solve sum based on expected return and standard deviation when probability was given. So with this we have completed the first topic under risk and return analysis based on expected return and standard deviation under two methods. One when probability is not given, the other when probability is given. So I hope everyone have understood this. Okay, now we will even take one more sum just to get our concept clear. The security return on stock of Cipla Limited and Lupin Fire Life Limited under different status of economy are given below. They have given us probability return of stock of Cipla, return of stock of Lupin. Okay, under 4 economic condition: boom, low growth, stagnation, recession. Calculate the expected return and standard deviation of return on both the stock and advise to invest in one of them. So first we'll start off with Cipla Limited. So under Cipla Limited, these are the following columns that are required. So we'll have particulars where we'll note down boom, low growth, stagnation and recession. We'll have probability, which is P, return of Cipla. Then we need to find something called as expected return. So we need ER. Then we have R minus ER. Then R minus ER the whole square, and P into R minus ER the whole square.
So okay, let us start one by one. So under particulars, we'll note down boom, low growth, stagnation and recession. Under probability, we have 0.35, 0.25, 0.25, 0.15. Under returns, 46, 42, 38 and 28. The next column will be P into R. It's not R into R, okay? It is P into R. That is probability into the return. So we just multiply P into R. So 0.35 into 46 will give you 16.1. 0.25 into 42 will give you 10.5. 0.25 into 38 gives you 9.5. 0.15 into 28 gives you 4.2. The total of which is 40.3. So that is nothing but their expected return in total. The next thing what you need to find is R minus ER bar. That is nothing but the expected return. Okay, so R 46 minus 40.03, 42 minus 40.03, 38 minus 40.03 or 40.3 and 28 minus 40.3. So we get the value as 5.7, 1.7, negative 2.3 and negative 12.3. Next step is to find the square of it. So 5.7 square, 1.7 square, 2.3 square and 12.3 square. All the squares of all the numbers are always positive. So it will become 32.49, 2.89, 5.29 and 151.29. The last step, whatever you got a recent value, multiply that with the probability. So it will be 32.49 into 0.35, 2.89 into 0.25 and so on. So the value that you should get is 11.3715, 0.7225, 1.3225, 22.6935. The total of which comes to approximately 36.11. That is nothing but the variance. So once you get the table done, only two things I have to find. They ask us to find the expected return and standard deviation. Expected return is nothing but the first answer that we got, that is 40.3%, and standard deviation is the root of variance. So it is the root of variance, that is root of the last column. So the square root of 36.11 is 6.009. So remember, expected return 40.3 and the standard deviation is 6.009. This is for Cipla Limited. Now the same thing we'll have to find for Lupin Limited in the same order. Okay, same columns. So we have particulars. So we'll have boom, low growth, stagnation and recession. We note down the probability, all the probabilities the same, 0.35, 0.225, 0.25, sorry, 0.25 and 0.15. The returns are 39, 36, 34 and 30. Okay, next column we multiply them, we find the expected return. So we get 13.65, 9, 8.5 and 4.5. Add up, we got 35.65. Next is R minus ER bar. So that will come 3.35, 0.35, negative 1.65, negative 5.65. Next column, the square of it. So 11.225, 0.1225, 2.7225, 31.9225. And lastly, we have to multiply the square with the probability. So we get the value as 3.927875, 0.030625 and so on. The total of which comes to 9.4275. Approximately up to 4 decimal you all can solve it. Okay. So lastly, we just put it into the account, into the frame statement. The expected return is 35.6. I remember for Cipla it was 40 point something. So based on expected return, Cipla Limited is much more better. And standard deviation, okay, when we calculate the standard deviation, okay, that is root of 9.4275, it comes to 3.07. So now based on expected return, Cipla is better because giving you a higher return, but as per the risk, that is standard deviation, the risk is less here. There it was 6.009, here it is 3.07. So overall, okay, your advice would be if you have to invest in any one of them. So if you are looking in for expected return, then Cipla Limited will be a much better option because you are getting 4% extra. But if you are looking at the risk point of view, Lupin Limited is better because it's 3 point lesser as compared to the Cipla Limited.
Okay, so with this we have completed the type 1 sum based on expected return and standard deviation. So now let us go ahead. Okay, the type 2 is again based on risk return analysis. Under that we are now need to calculate beta and covariance. So in this sum, now the sums that we are going to revise will be how to calculate beta and covariance under the same topic. Chalo, let us see one by one. Okay, now let us see how to calculate beta and covariance under the chapter risk and return analysis. Now before solving, let us see the formulas of calculating beta and covariance. Now beta का formula is covariance upon standard deviation square m, where covariance RS into RM, that RS stands for return on security, RM stands for return on market portfolio. Now always remember, whenever you're calculating beta and covariance, you are going to compare the security return with the market return. Covariance का formula is sigma RS minus R bar S into RM minus R bar M upon n minus 1, and standard deviation square m का formula is summation of RM into RM bar the whole square upon n minus 1. Now looking at the formula, it looks a little complicated, but while actually solving it, it is very simple. Okay, so let us see now how to solve the sum. Number 1, from the following data, calculate beta and covariance. They are giving you the number of years and they are giving you return on security. We will consider this as RS, and return on market portfolio, which will be known as your RM. Now based on this, let us see how to solve the sum. So our table will be in such a way that we'll have years, we have return of security, return on market security or market portfolio. Then according to whatever we require, for covariance I need RS minus R bar S, RM minus R bar M, and then the summation, the multiplication of both. So the 3 column will be based on covariance, and for getting standard deviation square m, that is RM minus R bar M the whole square. Okay, that will be our last column. Now let us see how we fill up the values. So years we will note down, we have 5 years, 1, 2, 3, 4 and 5. Now under return on security, we will write 35, 38, 34, 40 and 43. Now once you have written of the values of return on security, see that you all added up, because I need R bar. R bar is nothing but the average. So 35 plus 38 plus 34 plus 40 plus 43, the total will come up to 190. Similarly, we'll even note down the market return or the market portfolio return: 22, 26, 24, 28 and 30. Once we note down all the values, total it up, the total will come approximately 130. Now once we have noted the total of return of security and market, the next step will be we need to find R bar S, that is the average of return of security. That will be nothing but summation of RS upon number of years, which comes to 190 upon 5, which comes to 38. Similarly, we also need to find R bar M, that is nothing but the average of RM ka total upon N, that is nothing but 130 divided by 5, which will come to 26. Okay, that's the very first step that needs to be noted. Now once we have got the values of the averages of return of security in market, we can go to the next column. Our next column is RS, that is return of security. So each return we'd have to subtract that by the average return. So 35 minus 38 will be negative 3, 38 minus 38 is 0, 34 minus 38 is negative 4, then we have 40 minus 38, that is 2, and 33 minus 38, that 43 minus 38, that is 5. Similarly for market, 22 minus 26, that's negative 4, 26 is 0, 24 26 is negative 2, then we have positive 2, and lastly we have positive 4. The next step is we need to find the product of the first, second, fourth and fifth column. So that will become negative 3 into negative 4 is 12, 0, positive 8, 2 2s are 4 and 5 4s are 20. Once you get the second last column got values, see that you all total it up. So 12 plus 8 20 plus 4 24 plus 20 is 44. And now the last column, that is nothing but RM minus RM bar the whole square. So the square of the fifth column. So negative 4 का square is 16, 0 is 0, negative 2 is 4, positive 2 is also 4, and 4 4s are 16. Once you get all the values, see that you'll total it up. So 16 plus 4, 20, and another 20, so our total will come to 40. With this, our entire table has been completely done. Now we just have to apply into the formula. Now in order to get beta, first I need to find the covariance, because the numerator stands for covariance. So first we will find the covariance. So covariance ka formula we'll first note down. Covariance is nothing but RS into RM, the formula for which is summation of RS minus R bar S into Rm minus R bar M upon N minus 1. Now Rs minus R bar S into Rm minus R bar M, the total is 44 upon N, that is 5 minus 1. So that was nothing but 44 divided by 4. So our covariance is nothing but 11. Okay, so that's the first thing that we have found. Now second, we need to find the standard deviation square m. That's the denominator part for getting the value of beta. So that will be sigma Rm minus R bar M, the whole square, upon N minus 1. Now Rm minus R bar M, the whole square ka summation is nothing but 40, the total. And bottom again it will be 5 minus 1, so it will be 40 divided by 4, which comes to 10. Okay, so we got the numerator value, we have got the denominator value. Now we can use the final formula. Beta is equal to the covariance. When you're finding a covariance between market and the security, upon standard deviation square m. So that is nothing but 11 divided by 10. So we have 11, we have 10. When you divide it, we get the answer of beta, that is 1.1. So this is how you all had to solve the sum under the chapter risk and return analysis. Again, a very important topic for all the TYBMS student. Okay, the formula for beta and covariance and standard deviation square m is given. You just have to apply into the table, make the table, and just apply the values and get your final answer. Okay, I hope everyone has understood this. Okay, in the similar manner, we will take one more sum for a particular revision.
Security return of Indicode, Shoe Limited, and the market return are given below. So they are giving you returns of security of Indicode, Shoe Limited, and market return. Calculate the beta on security of Indicode, Shoe Limited. So we need to find the beta. So the columns, first we note down. So we written here Indicode Limited, Shoe Limited, Indicode. Okay, we have years, return of security, market return, RS minus RS bar, RM minus RM bar, RS minus RM bar into RM minus RM bar, and lastly RM minus RM bar, the whole square. So under years, we note down the years 1, 2, 3, 4, 5, 6, 7. Under return on security, we note down the return of security ka column, and we get the total. Total comes to 133. Same way, market return, we note down all the values of market return and get the total. It also comes to 133. Once we get RS ka total and RM ka total, we need to find two things. We need to find RS bar and RM bar. The formula is RS, total of RS upon the number of years, that is 7. So 133 divided by 7 comes to 19, and then RM bar is nothing but total of RM divided by 7, so which is again 19. So the next column now we need to find is RS minus RS bar. So all the values of security return RS minus 19. So 13 minus 19, 15 minus 19, 16 minus 19, 19 minus 19, and so on. We get the value as negative 6, negative 4, 3, 0, 2, 4, and 7. Next column RM minus RM bar. So again all the values of RM 13, 14, 17, 19 and all, minus with 19. So we get again negative 6, negative 5, negative 2, 0, 2, 4, 7. Next column is RS minus RS bar into RM minus RM bar. So we need to multiply these two columns. So 6 into 6, minus 6 into minus 6 is positive 36, 26, 0, 4, 16, 49, and I need the total of this particular column, so which comes to 131. Next is only RM bar ka square. So 6 6 are 36, 5 5 are 25, 2 2 are 4, and so on, and the total of the last column, which comes to 134. Finally, we apply into the formula of beta. So beta is sigma rs minus rs bar into rm minus rm bar. So that's second last column, divided by rm minus rm bar the whole square, that is the last column. So 131 divided by 134, we get the value as 0.978. So this is all you all need to solve and calculate beta. Okay, so you can go through it once in the most simplest manner. Okay, so with this we have completed the topic based on beta and covariance. So this is another way how you all can solve the sum. So now let us jump ahead and go towards type 3. Now type 3 is again based on risk return analysis. Under that we need to now calculate the holding period return and the annualized rate of return. So let us see how to solve the sum based on holding period return. Okay, now let us see how to calculate the holding period return and the annualized rate of return under the chapter risk and return analysis. This is the third part of this chapter. The first one was based on expected return and standard deviation. Second is covariance and beta. And third is holding period return and the annualized rate of return. Now, in order to solve the sum, first let us see what are the various steps that are required to be considered before solving the sum. So the steps that are there are, first you need to calculate the purchase price. Second, you calculate the dividend. Third, the bonus. Fourth, the selling price. Fifth, we use the formula for finding holding period return. And last, we find the annualized rate of return. Now, this is the complete set of steps that are required to solve the sum. Now, in each and every sum, all these things won't be given, but we are going to take one comprehensive sum which will have all the things. Now, for example, if a sum does not have bonus share, so the step number 3 will get skipped out. If it doesn't have dividend, step number 2 gets skipped out. But these are all the steps that needs to be followed. So we are going to take a one sum which has each and everything from top to bottom. All the values will be there. Okay, so based on the question, you can, you'll have to read out the question once, and based on the question you can omit the step according to whatever detail have been given. If nothing is given, no detail, each and every details are given, then this is the step that we need to follow. Okay, we'll read the question first. Mr. Max purchased 1000 shares of ABC Limited at the rate of rupees 100 each on 1st Jan 2009. He paid brokerage rupees 500. In 2010, he received bonus in the ratio of 3:5. He received dividend from the company as follows. So there are 2 dividends which have been given. Then he sold all the shares in Jan 2010 at 135 rupees each, and he paid a brokerage of 875 rupees. Calculate the holding period return and the annualized rate of return. Now if you look, the sum has something related to purchase, it has bonus, it has dividend, and it has the values of sales. Along with that, there are some brokerage also involved. Now always remember, brokerage, on purchase we add brokerage, and on sales we will less brokerage. Okay, brokerage gets always added to purchase and it always gets subtracted from sales. Now let us see how to solve the sum. Okay, now as per the steps, the very first thing that we need to calculate is the purchase price. So step number 1, so we will first find the purchase price. Now purchase price is given that Mr. Max purchased 1000 shares of 100 each. So it will be 1000 shares of 100 each. So that comes to rupees 1 lakh. But the issue was he has also paid 500 for the shares. Okay, he has paid rupees 500 as a brokerage. So that brokerage rule is, on purchase price we always add brokerage. So we will add brokerage of rupees 500. So my total purchase price is nothing but now 1 lakh rupees, 1 lakh 500. Okay, that's my purchase price, or it can also be called as price at the beginning. Okay, we'll keep it as price at the beginning. That is nothing but the purchase price at the start. So number 1 is done. Second, we need to calculate the dividend. Second is dividend. Now
in the question they've already given a dividend that he has received dividend for 2 years, for 2009 and 2010. So dividend is equal to rupees 500 plus rupees 750, which comes to rupees 1250. So that's our second value that we have already found. We found the purchase price, we have found the dividend. Next is you need to calculate the bonus shares. So third, we'll find the bonus shares. Now always remember, in order to find bonus, it's always better to do a small working that will be held and got. In the question is given that in 2010 he received bonus in the ratio of 3 for every 3:5, meaning you are going to get 3 shares for every 5 shares held. So if you have 5 shares, you will be getting 3. Now how many shares do we actually have? Now at the start we have 1000 shares. So for 1000 it will be how much? Okay, so we'll have to cross multiply. So it will be 1000 into 3, that is 3000. 3000 divided by 5, we will get the value of bonus as, 3000 divided by 5 is 600 shares. So we have bonus of 600 shares. So now remember, we had 1000 at the start, plus now we got 600 bonus shares. So in total now we have 1600 shares. So we'll note down here now, total number of shares is equal to 1000 plus 600, which comes to 1600. The next step is now we need to calculate the selling price. So step number 4, we'll find the selling price. So selling price, now here they have given you sold all the shares for 135. Now we have total 1600 shares and we are selling it for 135 rupees each. So 1600 into 135, that comes to approx 2,16,000. Again, there is some brokerage which was paid. On purchase we add brokerage, so on sale we will be we will have to subtract the brokerage, so less brokerage. Okay, the brokerage value was 875, so it will be less. So my total selling price will be 2,16,000 minus 875, which comes to 215,125. We got the purchase, and this is also known as, we can also know that write this as price at the end. Okay, price at the beginning is purchase, price at the end is your sale. Now once we have found the selling price, now we come to our actual formula, that is holding period return is equal to, we'll know the formula first, that is price at the end minus price at the beginning plus dividend upon price at the beginning into 100. So here price at the end was 215,125, that is the selling, minus price at the beginning was 1,05,000, dividend was 1250 upon price at the beginning, that was 1 lakh into 100. Now by solving this values, okay, so we have 2,151,000, so we have 215,125 minus 1,005,000 plus 1250 divided by 1,05,000 into 100, the value comes to 115.29 something, so we'll round it up to 30%. So my HPR is 115.30. Now last step, we need to find the annualized rate of return. So the annualized rate of return is nothing but the HPR divided by the holding period. So in our case it was 115.30 divided by, for how many years did you hold? Now here they are giving you got dividend for 2 years, so 2009 2010, so for 2 years we have held it. So our holding period, the annualized rate of return will be 115.30 divided by 2, which comes to 57.65%. So with that, the sum based on holding period return and annualized rate of return comes to an end. Okay, so these are the steps that you have to follow. Very simple sum. Now it's not necessary that in the sum they might have bonus. If it's not there, ignore the bonus part. Okay, if not dividend is not there, ignore that part. So it goes in the order. This is full-fledged sum. Okay, whatever is not there, you can ignore that particular step. So that was the third part in the chapter risk and return analysis. I hope everyone has understood how to calculate the holding period return and how to calculate the annualized rate of return. Okay, so these were type 3. Now let us jump ahead and go towards type 4, practical problem sum under this subject. Okay, the fourth type is under the topic portfolio performance measurement, where we are asked to calculate Sharpe's, Trenor's and Jensen's measure. So let us see how to solve sum based on this. Okay, now under the chapter portfolio performance measurement, the sum that usually comes is based on calculating the performance using Sharpe's, Trenor's and Jensen's measure. So now let us see how to solve the sum. Now this is always a compulsory question which usually appears in the paper. So let us see how to solve the particular sum having all the three types of measure. Now in the exam they can be asked any one or any two or even all three can come in that. Okay. So let us see in one sum how to solve all the three measures. Now we'll read out the question once. It's given that following are the details of three portfolios. So we have portfolio 1, 2 or 3. Then we have the market index. They are given as the average returns. They are given as the standard deviations and beta. The risk-free rate of return is 8%. You are required to compare these portfolio on the performance using Sharpe's, Trenor's and Jensen's measure, and then you have to comment on which one has outperformed the others. So now let us see one by one, okay, how to solve the sum. We will have to first start with, what we'll do here is we'll start number 1, first solving using Sharpe's measure. So under Sharpe's measure, okay, we will first note down the formula and thereafter we can apply or we can substitute the value on it and get the final answers for different portfolios. So first we note down the formula. So I'll write here that Sharpe's ratio or measure is equal to R, that is average return, minus RF, that is risk-free return, upon standard deviation. Okay, very simple formula. Average return, that is R, minus RF, risk-free return upon standard deviation. Now for all the values, okay, for all the three portfolios that we have, average return is given yes, standard deviation is given yes, and the risk-free rate of return is also given. So very simply we just have to apply it into the formula. So now for portfolio 1, okay, for portfolio 1, when you use the Sharpe's formula, it will be R minus RF, so that will be 13, that is average return, minus 8 risk-free return, divided by the standard deviation, that is 0.25. okay, so 13 minus 8 divided by 0.25. now this is the standard deviation. Okay, so while calculating it, the answer that you should get is, the value that we get is 20. Okay, so that's the measurement, the performance measurement using Sharpe's ratio for portfolio 1. Similarly, we will see for portfolio 2, it will be average return, which is 12 minus 8 divided by, now again the standard deviation is 0.25, So 0 divided by 0.25, the value we'll get is 16. And for third portfolio, it would be 11 minus 8 divided by 0.20, which comes to 15. Now based on that performance, okay, now we have to give a comment which one has outperformed all. So as per the sharpest measure, we can say that portfolio 1 has outperformed. Okay, that's our comment on our sharpest measure. Okay, a very simple sum to solve. Okay, now let us see the second method. It's known as the Trenner's measure. So we'll just note down the heading. This is based on Trenner's measure. Again, first we'll note down the formula. So Trenner's ratio is equal to, it is similar, just one change. It will be average return R minus risk-free return, that is RF, upon beta. Okay, so in Sharpe it is standard deviation, under Trenner's it is beta. So now let us apply these values for each of the portfolios. So number 1, for the first portfolio it will be average return, that is again 13 minus 8 divided by the beta, that is 1.25. So when you minus and divide, you will get the answer as 4. Now same way for the second one. For the second portfolio it would be 12 minus 8 divided by 0.75. Okay, after minusing and dividing, the value you should get would be approximately 5.33. And the third one, it would be 11 minus 8 divided by 1. So 11 minus 8 would be 3, divided by 1 would give you 3. So now based on Trenner's ratio, okay, based on Trenner's ratio, if we need to say which one has outperformed, we can clearly see that portfolio 2, the value is the highest, has outperformed the remaining. So as per Trenner, we can say that portfolio 2 has outperformed. Okay, again a very simple procedure to solve the sum. Now comes the third one. Now this is the most important. Okay, Jensen is the one of the most important because it has to be solved in 2 different steps. So we'll first note down the heading. Third, this is based on Jensen's measure. Okay, now in order to solve Jensen's measure, okay, the sum gets divided in 2 parts. So first, step number 1, we need to first find the expected return. Now expected return ka formula is the formula that we usually use for CAPM method. Okay, that is RF, risk-free return, plus beta into market return, that is RM, minus risk-free return. Okay, so this is one formula which has to be learned very carefully. Okay, risk-free return plus beta into RM minus RF, that is market return and your risk-free return. So first we have to calculate under step 1 the expected return of all the portfolios. So first we'll do for portfolio 1. The risk-free return was 8, which is fixed for all, plus beta, that is 1.25 for portfolio 1, into the market return. Okay, so the average return ka market is 11%, so we'll take it as 11 minus risk-free return, which was again 8. So it would be 8 plus 1.25 into 11 minus 8, which would be 3. So you multiply, you add, the value that you should have got for your portfolio 1 would have been 11.75%. Similarly, we need to find for portfolio 2. So for portfolio 2, the formula, again we go as per the formula. So risk free would have been again 8%. The beta for the second portfolio is 0.75. Again, market return and risk free would have been the same. When you solve it, the value that you all should have got would have been 10.25%. Same, we go for portfolio 3. Now portfolio 3 ke liye again start would have been same, 8 plus the beta value for third is 1, 11 minus 8. So the value that you all should have got would have been 11%. Okay, that's step number 1. So first we need to get the expected return for all the 3 portfolios. Now we jump to the second step. The second step states that, so I'll write here step 2. We need to find, we'll now note down the actual Jensen's formula. So we write here as Jensen's differential measure. It's called as Jensen differential measure. The formula is actual return minus the expected return. Actual is the average return which is already given, and expected which you have already found. So for each of them, so for portfolio 1, the actual return was 13% and the expected is 11.75. So when you subtract it, okay, for those, I'll note it down, this is for portfolio 1. So 13 minus 11.75 would give you 1.25%. Same way for portfolio 2, it would have been 12 minus 10.25, which would give me 1.75%. And for portfolio 3, it would have been 11 minus 1, which would give me 11 minus 11, which would give me a 0%. So now, based on Jensen's measure, the highest return which I can see is in portfolio 2. So I can, based on the measurement, I can say that portfolio 2 has outperformed. With this, the Jensen measure also comes to an end. So this is the sum which has to be solved when they ask you to find the performance using Sharpe's measure, Trenor's measure and Jensen's measure. So remember, Jensen has 2 parts, others they have direct formula and you just need to substitute the value. Okay, so with this, type 4 also comes to an end. Now let us jump to the next type number 5. Okay, now the type 5 is capital asset pricing model, also known as CAPM. So let us see what kind of sum can be asked based on capital asset pricing model or CAPM. Okay, now let us see how to solve the sum where we are asked to find expected return under capital asset pricing model, also known as CAPM model, okay, or CAPM method. The question given here is the expected return and beta of 3 securities are as follows. Securities are given, PQR, the expected returns are given, and the beta is given. Along with that, it is said that the risk-free rate is 9% and the market return are 14%. Now in this case, in the sum, if you look, they have already given us a market return and then they are given you expected return. Calculate the expected return for each securities under CAPM method. So we will first note on the formula and then we'll see how to solve this sum. Again, a very simple sum. Okay, so according to CAPM, okay, it will be according to CAPM method, the expected return is equal to risk-free return plus beta into market return minus risk-free return. Okay, that's the formula for finding expected return under CAPM. Risk-free rate is given to us. Beta are given for each security. The market return. Now, if you look carefully here, they have already given you market return. We already have a market return. So for all the cases, the market return will be 14, and again risk-free we have again as 9. So again, very simple formula. Now we'll just apply to each security and try to get the expected return under CAPM. So number one, for security P, the expected return is equal to risk-free return, that is 9, plus the beta, which is 1.7, into market return, which was 14, minus the risk-free return, which is 9. So while solving this, we would have got 9 plus 1.7 into 14 minus 9 is 5. Okay, so you multiply 1.7 into 5 plus 9, the answer that you all should have got would have been 17.5%. So the expected return for security P is 17.5%. Similarly, for security Q, the expected return is equal to risk-free 9 plus beta 0.6, and we have 14 minus 9, that is market minus the risk-free. So 9 plus 0.5 into 5, so it would be 9 plus the product of 0.6 into 5, so that would have given you total of 12%. So the expected return for security Q under CAPM is 12%. And third, for security R, the expected return is, again, the risk-free would be 9, beta is 1.2, and again you would have 14 minus 9 because that's the market return and risk-free return. So it would be 9 plus 1.2 into 5. You multiply, you add, the final answer that you all should have got would have been 15%. So again, a very simple sum. Okay, very simple. You just have to apply into the formula, get those values and note it down. Now, this is the first type of CAPM sum where the market return is directly given to us. So if you look carefully, we have not used anywhere the expected return because that's the old return and this is as per CAPM method. Okay. So now we are going to do the second, we are going to solve a second type of sum where what if market return is not given, then how are we supposed to calculate and find market return so that we can use that particular return in all the three cases. Okay, chalo, now we'll jump to the next sum where we have been asked to calculate the market return first and then solve and find the expected return under CAPM method. Okay, now this is the second variation under CAPM method sums. So here they are giving you particulars, they are giving you initial price of the security, they are giving you the market price of the security, and they are giving you the beta. The risk-free return is 12% and you are required to calculate the expected return of portfolio using CAPM method. So here if you look carefully, they have not given us the market return. So the very first thing that we'll have to do is we need to calculate the expected market return. Okay, so what we'll write here is step number 1. We'll need to find first the expected return on portfolio which will be considered as my RM. Okay, so my market return is equal to its market price less initial price upon initial price into 100, because we have been given market price and initial price. Now in such kind of sum, if dividend is given, so it will be market price minus initial price plus dividend is upon initial price into 100 will give you your expected market return. So now the market, so we'll have to take the summation of all the values. Okay, so our market prices are for all the portfolio is 38, 50 and 60. So it would have been the summation of 38 plus 50 plus 60, that's market price, minus the initial price, that is 26 plus 40 plus 48, upon initial price, again that would have been 26 plus 40 plus 48 into 100. So this would have come to, when you add up the values, you get 148 minus 114 upon 114 into 100. So on subtracting, dividing and multiplying, the expected market return that we will get would be approximately 29.82%. Okay, so this is, so we have now found the market return. Okay, so when market return is not given and they're giving you the initial and market price, this is how we have to start the sum with. Okay, we have to first find the expected market return. And now it's a normal. So now according to CAPM method, the expected return is nothing but risk-free return plus beta into the difference between the market return and the risk-free return. So for security P, the expected return would have been, now the risk-free is 12 plus the beta for the first one is 1.25 into 29.82 minus 12. This would give you 12 plus 1.25 into 17.82. You multiply, you add, you get your final answer as 34.275%. So the expected return for security P under CAPM is 34.275. Similarly, we need to find for security Q. Again, the expected return would have been 12 plus the beta is 1 into 29.82 minus 12. So it would be 12 plus 1 into 17.82. Multiply, add, you get the answer as 29.82%. That's the expected return for security Q under CAPM. And lastly, for security R, again the risk-free return, the risk-free return would be 12, so we don't need to note down the formula because it's already written, plus 1.33 into 29.82 minus 12. So this would have given us 12 plus 1.33 into 17.82. So you multiply, you add, you get your final answer as 35.70%. So that is the expected return for security R under CAPM method. So these are the two variations or two types of sum that could be asked under CAPM method for your exam. Okay, I hope everyone have understood both the types of sum, both the variation. Okay.
Okay, with this type 5 comes to an end. Let us start with the last type number 6. Okay, type number 6 is fundamental analysis, that is problem sum based on ratio analysis. So let us see what are the most important ratios and how to solve them.
Okay, now let us see how can we solve sum based on ratio analysis under the chapter fundamental analysis. Now before starting to solve, okay, let me just give you all a brief about this particular topic. Now in ratio analysis there are a lot of ratios that needs to be learned. Now this chapter has different types of ratios, so there is no basic fixed format what kind of sum can usually come. Okay, so it's only based on your formulas. You need to learn various formulas, and based on the formulas you need to substitute the value and get the answer. But now looking at past couple of years ka paper, okay, I've picked out two types of sum. We'll be doing a pattern of sum, okay, two sums which will have a pattern which was there in the previous papers. Okay, so we'll be taking up two sums which will be similar based on how the sums have come in previous papers. And thereafter, okay, I'll be noting down all the different types of formulas that you need to learn under ratio analysis. I'll note down the list, so you all can take a screenshot of those and you all can note it down in a book and learn over it. So basically it's what all the data is usually there in the question. You just have to get those values and substitute into the formula. Okay, so now first what you're going to do is we're going to solve two sums which are very peculiar from the exam point of view. So let us see how to solve those two sums first. Okay, now the first question says that following are the details of two companies, company A Limited and B Limited. They are given as equity shares, 12% preference shares, profit before tax, tax rate, dividend per share and market price per share. So these are the various details which are given. After that they are given you calculate earning per share, PE ratio, that is price per earning ratio, dividend payout ratio, return on proprietary fund. These are the four things they are asked us to calculate and find the answers for. Now let us see one by one. First they ask us to find is earning per share. Now earning per share ka formula is EAT, that is earning after tax, also known as profit after tax, less PD stands for preference dividend. Now in this sum I'm taking the abbreviation, but the the entire full form of those are already noted down. So once I finish those two sums, okay, then I will be putting out kind of a slideshow, you can say, where I have jotted down all the various formulas, okay, which are again very important for your exam point of view. Now earning per share is earning after tax minus preference dividend upon the number of shares. So now let us see how we can solve. We need to solve for A Limited and for B Limited. Okay, so now let us see. First of all, in order to find the EPS of A Limited, I need to first find earning after tax. Now remember, in our question they are giving you profit before tax, or we can say earning before tax. Now we needed earning after tax. So remember one thing, in order to find EAT, it will be nothing but earning before tax, which was 400 lakhs, less, I need after tax, so I'll have to minus the tax rate, so it will be less 30%. So 400 minus 30%, we will get the value as 280. So our earning per share ka earning after tax is 280 for A Limited, less preference dividend. Now preference dividend means dividend which is earned on preference share. I can see 12% preference share written here, meaning this is the rate of dividend. So 12% of the value of preference share, that is 100. So preference dividend, so I'll just note down here, PD is 100 into 12%, which comes to 12. So our preference dividend is 12 divided by the number of shares. Now number of shares is nothing but number of equity shares. So equity shares, in order to find the number, very simple, the total value divided by the face value will get the number. So 800 lakhs divided by 10, so I'll take it as we are taking in the form of numbers in lakhs as the entire sum. So it will be 800 divided by 10, so that comes to 80. So 280 minus 12 divided by 80, that will be our earning per share of A Limited. So that comes to approximately rupees 3.35 per share. Okay, so my earning per share is rupees 3.35 for A Limited. Now similarly we'll have to find for B Limited. So again I'll just note down the formula. EPS is equal to, first I need to find earning after tax. So earning after tax will be before tax, that was 600, less tax percent, which was 30%. So it will be 600 minus 30%. So our value will be approximately 420. So our earning after tax is 420 less preference dividend. Now preference dividend, again it will be 12% of the value. So it will be 200 into 12%, which comes to 24. So minus 24 divided by the number of shares. So 1000 divided by 10 comes to 100. So our earning per share for B Limited will be 420 minus 24 divided by 100, which will come to rupees 3.96 per share. So our earning per share is rupees 3.96 for B Limited. Okay, so that was the first formula we have completed, that is earning per share. Next is they have asked us to find is PE ratio, that is price earning ratio, which is market price of the share divided by earning per share. So again we note down the formula. I will first note down the name of the two companies. We have A Limited and B Limited. Okay, now very simple. We have already found one part of that sum. So see how we need to find PE ratio. So PE ratio is equal to market price per share. Now here's given market price per share of A Limited is 150. So it will be 150 divided by earning per share of A Limited. We already found that in the first formula, which is 3.35. So 150 divided by 3.35, we will get the value approximately 44.78 times. So it is in times always. Okay, so our PE ratio for A Limited is 44.78 times. Similarly for B, we have to, again it will be PE ratio is equal to market price of the share was 120 divided by the EPS of B Limited was 3.96. Okay, Achha, one more thing which we missed out here was this whole thing is into 100. Okay, no, this is not 100. It's just as it is. Okay, because we already got it in time. Because if it is in percentage, it will be in percent form then. So 120 divided by 3.96, value will come to 3.30. Okay, 3.30. It will be 30.30. Okay, so 30.30 times is the answer for P ratio for B Limited. So very simple. It was market price, which is there in the question, EPS, which we have already found. The next is that was the first and the second formula. Third, what they've asked us to find. So this was my first, this was the second. My third one is dividend payout ratio. The formula is DPS, that is dividend per share, upon EPS, that is earning per share, into 100. Now this is into 100. So now here I write it as A Limited and this is B Limited. Now first of all we need to find dividend per share. Okay, we need to find DPS and for A Limited and for B Limited. So first, before starting anything, we need to first get the value of DPS. Now if you look in the question very carefully, I can see here something written as dividend per share. So we already have DPS given in the question. So for A Limited, the dividend payout ratio is equal to dividend per share, which is rupees 3, upon earning per share, that is 3.35 into 100. So when you divide and multiply, your dividend payout ratio, we call it as DPR, will be equal to approximately 89.55%. Same way we go, we solve it for B Limited also. So it will be dividend payout ratio is equal to dividend per share for the B Limited is rupees 2 divided by the earning per share, that is 3.96 into 100. So again, when you divide, multiply, your answer should have been approximately 50.50%. So if you see very carefully, we are not doing anything great. Okay, we are just using the formula and substituting the value from the question and whatever they have given us. Okay, so we have done with the third one. Last, we need to find return on proprietor's fund Okay, now return on proprietor fund is also known as return on capital employed, the formula for which is EBIT upon total capital employed. Okay, so something new now this is. So A limited, B limited. Now, in order to find the return on proprietary fund for the first one, or capital employed for A limited, earning before interest and tax. Okay, very important. We need to first get the value EBIT. Now I can see, we can already see a profit before the tax, meaning that is profit before the value of interest and tax which is given. And since there is no debentures, no debt fund, so there is no interest that can be calculated. Okay, so we consider that as an EBIT, which is 400 upon total capital employed. Now what is total capital employed? Total capital employed is nothing but all your reserves and surplus, all your capital fund and all your borrowed fund together. So I have equity share, I have preference share, and I have reserve and surplus in the form of profit and the profits. So now what happened here is, when you add up, okay, now they asked you to find the total capital employed. So when you add up all your how we'll do it, equity share is 800, so we'll note down here this as 800 plus preference share of 100 plus reserves and surplus of rupees 100 into 100. So now here, okay, now this is also into 100. Okay, so here I have not mentioned here, so it is into 100. So it will be 400 divided by 1000, so that comes up to, so I'm taking it on the calculator, 400 divided by 1000 into 100, so that comes to 40%. So our return on capital employed or return on proprietary fund for A limited is 40%. Similarly, we need to find for B limited. So now B limited profit before interest and tax is 600 upon 1000 is equity share, 200 is preference, and profit is, okay, my bad, the profit is 400 for A limited. Okay, so this will be 400. So here it becomes 400 plus, sorry, divided by 8 plus 1 9 plus 4 is 1300. So it will be 1300 into 100. So that comes to 30.76%. Okay, so we will change this value here. It will be 30.77%. Okay, and not 40% because I missed out. It's 1000. It's 400. I've taken that at 100. Similarly, here it will be 1000 plus 200 plus 600 into 100. So now this comes to 1000 plus 200 is 1200 plus 600 is 1800. So it will be 600 divided by 1800 into 100. So that comes to 33.33%. Okay, so this is how the sum was supposed to be solved. So it's very simple. You just need to note down the formulas. Okay, substitute the value from the question, post it here, and just divide, multiply, add according to the formula, and you will be getting the answers. So this is one of the sums, okay, which as per the paper pattern which has been there throughout. Okay, this is one of the kind of sum which is always asked. Okay, now we'll be doing one more similar kind of sum to clarify the doubt based on where they ask you to find earning per share, dividend payout, PE ratio, return on equity, all these kinds of formula. Okay, so now let us see how we solve the second sum based on ratio analysis. Okay, now again here we have they are giving you detail of two companies, A limited and B, equity, preference, profit after tax, proposed dividend and market price of the shares are given. They are asking us to find earning per share, PE ratio, dividend payout and return on equity shares. So let us start one by one. First, earning per share. First we will find for A Limited and thereafter B Limited. So earning per share of A Limited is earning after tax. Now in this sum they have already given you profit after tax. So it will be 50 minus preference dividend. Now again, in order to find preference dividend, very easy. Preference share ka value into the rate. So 80 into 12% will give you 9.6 upon number of shares. So it will be 200 divided by the face value. So it comes to 20. When you divide, you will get the value as rupees 2.02. So your earning per share of A Limited is 2.02. Similarly for B Limited, we'll have EPS is equal to earning after tax, that is 70 minus preference dividend. So that will be 100 into 12%, which comes to 12 upon the face value of the equity share or number of equity shares. So it will be the value divided by the face value. So it comes to 25. 70 minus 12 divided by 25, the value that you all should have got would have been 2.32 rupees. Okay, again we are just using the values from the question and substituting in the formula. Second, PE ratio, again for A Limited and for B Limited. So the PE ratio for A Limited will be market price of the share, that is given market price for share is given as 100 upon EPS, which you have already found 2.02. You divide and we get the the price earning ratio, which is approximately 49.50 times. Similarly for B Limited, the PE ratio will be, the price earning ratio is the market price, which is 140 upon EPS, that is 2.32. So it will be approximately 60.34 times. Okay, you can write the whole thing in a single line, okay, because there is place constraint, so I'm taking it in that way. So that's the first and the second formula. Third is dividend payout, very important. Again, we need to calculate for A Limited as well as for B Limited. Okay, now in order to find now DPS upon EPC, dividend payout ratio is DPS, that's dividend per share. Now dividend per share is not given here. In the previous sum, dividend per share was given. So DPS is nothing but the proposed dividend, which is 35 upon the number of shares. 200 divided by 10 is 20. So that comes to 1.75. So now DPS is 1.75. EPS is 2.02 into 100. So that will come approximately 86.63%. So see, again it is all based on formulas, okay. Similarly for B Limited, the dividend payout ratio is, I need DPS, so DPS will be dividend per share, so that is proposed dividend 40 upon the total number of shares. So it will be 250 divided by 10, which comes to 25, so which comes up to 1.6. So I use that 1.6 upon EPS, that was 2.32 into 100, so which comes approximately 68.97%. Again, we are just substituting the values from the question into our formula. Next formula was return on equity share. The formula is earning after tax minus preference dividend upon equity capital into 100. So now let us see how to calculate this. Earning after tax, they have already given us 50. Preference dividend, we have already found PD here, which was 9.6 upon total equity capital. Now equity capital here was 200 into 100. So when you subtract, divide and multiply, the value on return on equity share you would have got as 20.2%. Same way we need for B Limited. So again, earning after tax was 70 minus preference dividend, which is, now again here we have already done that, which is 12 divided by the total capital, which is 250 into 100. So you subtract, you divide, you multiply, you get your final answer as 23.2%. So with that, our second sum has also been completed. Now these are only the first two types of sum that we have done, which are on the similar line. Now this chapter has multiple types of sum. Variations are very much there. Okay. Now the only thing which I will suggest everyone is learn the formula. Once you know the formula, you just have to substitute the values. Okay, and just remember what is earning after tax, what is earning before tax. Okay, how to get the number of shares, what is dividend per share, how to get those values. Only those formulas you need to learn, because with that you can substitute and get your final answer. Okay, chalo, with that the two sum based on ratio analysis has been completed. Okay, now okay, we will be taking up one more problem sum just to get a revision on ratio analysis, and thereafter we will note down all the ratios which are very important from the exam point of view. Okay, the next question is based on ratio analysis. The question reads as: the balance sheet of Oberoi Realty Limited is given to you. They are giving you liabilities and assets, profit after tax, market price per share, and dividend per share. They are asking you to calculate 5 things: current ratio, earning per share, price earning ratio, dividend payout ratio, and debt equity ratio. So the very first term, current ratio, formula is current asset upon current liability. Now current assets, may we have inventory, debtors, cash, and advance salary. So we noted down all those four. Under liability we have bank overdraft, creditors, and outstanding expense. We have noted down, added up, divided, we got the value as 1.1765. The second question is earning per share. Formula is profit after tax minus preference dividend upon number of shares. So profit after tax was 8 lakhs. Preference dividend is based on preference share, that is 8% of 20 lakh, which comes to 1,60,000, divided by 5 lakhs, that's the number of shares. We got the value as 1.28 rupees. Okay, so these are the first two formulas, current ratio and earning per share. Next we have price earning ratio. The price earning ratio ka formula is market price per share upon earning per share. Market price is 25, earning per share we just now found 1.28, divided, we got the value as 27.3438. Next is dividend payout ratio. Formula is dividend per share upon earning per share into 100. Dividend per share is given here 25, earning per share was 1.28 into 100, we got the value as 1953.15. And last, debt equity ratio, that is total debts upon equity fund. The total debts is debentures, which was 15 lakhs, and equity fund was equity share plus reserve and surplus plus equity share, preference share plus reserve and surplus less fictitious asset. So 50 lakhs plus 20 plus 8 minus 3, we got it as 75 lakhs. So 15 lakh divided by 75, we got the value as 0.2. So these were the remaining three ratios. You all can go through it once. Okay, so this is how you all had to solve the sum based on ratio analysis. Now let us go ahead. Okay, now here are the list of all important ratios that you need to cover up for your examination. Okay, so with that we have completed the entire revision of IAPM. Chalo, I hope everyone have noted it down. With that we'll be ending this video here. Thank you.